You landed the deal, your goods are on a ship or already delivered, the invoice is issued, and now you wait. 60 days, 90 days, maybe 120. In international trade, extended payment terms are standard. Buyers expect them. What is less talked about is what that wait costs you as an exporter, in cash flow, in growth capacity, and in the ability to take on the next order. In this video, we are going to walk through the core tools that let U.S. exporters turn foreign receivables into working capital without waiting for the buyer to pay. The problem is straightforward. When you sell internationally, foreign buyers routinely demand payment terms of 60, 90, or even 120 days. That is not unusual. It is the norm in many markets. But your costs do not wait. Payroll, production, raw materials, shipping. Those obligations come due regardless of when your buyer settles. For growing exporters, this gap compounds quickly. The more deals you close, the more cash is tied up in outstanding receivables. And traditional bank lines often do not help because many domestic lenders will not count foreign receivables as eligible collateral. The credit and legal complexity of collecting from a buyer in another country makes them nervous. There are two primary categories of solution. The first is receivables financing, using your existing foreign receivables as the basis for immediate cash. You sell or pledge those invoices to a lender or factor, and they advance you 70 to 90% of the invoice value upfront. The lender then collects from your buyer when payment comes due. The second is supply chain finance, which works differently. This is typically a buyer-led program where a large corporate buyer arranges early payment to its suppliers through a bank. You get paid early, the buyer pays the bank on the original extended terms. The key difference: in supply chain finance, the financing cost is based on the buyer's credit rating, not yours. If your buyer is a large creditworthy company, that can mean significantly lower rates than you could access on your own. Within receivables financing, it is worth understanding the difference between factoring and invoice discounting. They solve the same problem, but in different ways. In factoring, you sell the receivable outright to a factor. They take over the collection process, and your buyer knows the factor is involved. This is simpler to administer. You are not managing collections, and it is often a good fit for smaller exporters or those without the infrastructure to chase international payments. Invoice discounting works differently. You borrow against the receivable rather than selling it. You retain collections responsibility, and crucially, it is confidential. Your buyer continues to deal with you directly and does not see a third party in the relationship. For larger exporters or those with long-term buyer relationships they want to preserve, invoice discounting tends to offer more flexibility and typically better pricing. Here is where trade credit insurance connects to the financing conversation in a way that many exporters miss. Insurance does not just protect you from buyer default, it also makes your receivables more attractive to lenders. When a lender knows your receivables are insured, they are carrying far less risk. The practical result: advance rates go up. On an uninsured portfolio, a lender might advance 70 to 80%. On an insured portfolio, that often jumps to 85 or 95%. Some lenders require trade credit insurance as a condition of the financing facility. Others simply price insured facilities better. Either way, combining insurance with receivables financing gives you two things at once: faster access to cash and protection against the scenario where the buyer never pays at all. We talked about EXIM Bank in detail in the previous video, but one of its programs fits directly into this conversation. The working capital guarantee is different from EXIM's insurance products. Rather than protecting against a buyer failing to pay after shipment, it solves the pre-shipment problem. EXIM guarantees 90% of an export working capital loan issued by your bank. Because the bank is only carrying 10% of the risk, it becomes far more willing to lend against your export orders and foreign receivables before your goods ever ship. The coverage includes both pre-export production costs and post-shipment receivables. For U.S. exporters who qualify, with at least 50% U.S. content in their exports, this can open access to credit that traditional bank lines simply would not cover. There is no single right answer to how you structure this. The right approach depends on your buyers, your markets, your transaction sizes, and whether you have a banking relationship that can support it. For a smaller exporter with a diverse buyer base, a factoring or invoice discounting arrangement on a portfolio basis is often the simplest path. For exporters who sell regularly to a large creditworthy corporate buyer, supply chain finance through that buyer's program can be the most cost-effective option available. For exporters with a pre-shipment cash gap, winning contracts but needing capital before goods ship, the EXIM working capital guarantee is worth exploring with your bank. And for many companies, the most effective structure combines elements of all three: insurance on the receivables portfolio, a financing facility that advances against those insured receivables, and access to government-backed working capital where it fits. Impello's role in this is advisory. We are not a bank, and we do not manage lender relationships on your behalf. What we do is help you understand your receivables portfolio, clearly enough to have the right conversations with lenders, with your bank, with EXIM Bank if that path is relevant. We look at who your buyers are, what payment terms you are extending, which markets you are selling into, and what your exposure looks like on any given day. From there, we can help you identify which financing structures are realistic for your profile, where trade credit insurance would strengthen the financing case, and what questions to ask before you sign a facility agreement. The goal is not to hand you a product. It is to make sure you understand what you are getting into and why it fits. Your foreign receivables represent real economic value. They are money that is owed to you. The question is whether you have to sit on that value for 60 or 90 days, or whether you can put it to work in your business now. Financing structures exist that can change that calculus without requiring you to take on additional credit risk or give up control of your customer relationships. If you're extending terms to foreign buyers and the weight is constraining your growth, it is worth understanding what options actually exist for your specific situation. In the next video, we cover political risk insurance. What happens when a foreign government expropriates your assets, blocks your funds, or cancels a contract for political reasons, and the tools that protect your international exposure before something goes wrong. Subscribe so you do not miss it, and drop any questions about receivables financing in the comments below.